Welcome everyone to today's Title Topics webinar, ALTA's free presentations that we offer monthly on issues important to title professionals. I'm Jeremy Yowie, ALTA's Director of Communications, and today we will be talking about why title companies should review and understand the business practices followed by the vendors they utilize. This is a timely webinar as ALTA's Board of Governors approved a motion in June encouraging members to conduct a self-assessment by September 2014. And to help with this, ALTA, with guidance from its Best Practices Task Force, is developing assessment readiness guides to help members determine if they're prepared to undergo an assessment and to help them determine compliance with best practices. And if you need more information on that, please go to ALTA's website. That's alta.org/best practices. And just before we get into the meat of today's webinar, I just need to touch on a few housekeeping items. A copy of today's presentation was emailed earlier today to all registrants. If you didn't receive it, please shoot me an email at jyohe@alta.org. Again, that is jyohe@alta.org, and I will send you a copy after the webinar. All participant lines are muted for today's presentation. If at any time you have a question, please use the chat box function, and we will address questions at the end of the webinar. And as an added benefit, the presentation is being recorded. After it's processed, the recording will be available on ALTA's website at alta.org/title topics. And I need to thank SoftPro once again for sponsoring our Title Topics webinars. Their support allows us to continue providing these education opportunities free of charge. With all that out of the way, let me introduce today's speakers. Joining us, we have Brian Twibell, Chief Executive Officer of RedVision. As one of the company's original investors and co-founders, Brian took the role of Chairman and Managing Director in 2002 and was named CEO in 2006. Before launching RedVision, Brian was President and CEO of Microbank Software, a firm he founded in 1984. Also joining us, we have Richard Bramhall, Corporate Counsel for Westcor Land Title Insurance Company. And in this role, Richard is in contact with federal and state regulatory authorities, and he also develops policies and procedures for Westcor contracts, agency agreements, and national underwriting guidance. And prior to joining Westcor, Richard served as Chief Title Officer at Bank of America. And with that out of the way, Brian, I will now turn the presentation over to you.
Thanks, Jeremy. I think, as indicated by the reasonably high amount of attendees here, it's certainly very topical. The regulatory environment. In our capacity as a provider to industry, we attend all the various trade shows. So the MBA, the ALTA conferences, the National Settlement Conference, and pretty much if you look at the topics and the panels, this is certainly out there. But I think one of the things we were hoping to do with this seminar is, some things are clear, some things are out there, and there's a lot of clarity around what compliance means. But there's also a lot of unclear, and very often beyond the panels, it's the hallway conversations or sitting down with a lender where you get some perspectives of how people are thinking and what they're sort of forecasting for the changes to be. So it's as much as there's some clarity, I think there's also a lot of uncertainty, which can be a problem, right? Because with uncertainty or with certain types of fears out there, there can also be overreactions. So I think this is it's obviously a great topic. A lot of people are interested in it. There's lots of companies that I think could bring great insight. I think the one thing good about it being Westcor and RedVision is that we're really on two very, very opposite sides of the spectrum. Westcor is an underwriter. They've got an ear to the lender. They know what they and some of their peer underwriters are looking for with regards to agents. We, on the other hand, are in the transaction chain. We're a provider of title and examination services, so we are a production partner, and we are exposed to a lot of the the changes that our clients are asking us for. So hopefully we'll be able to share that. As Jeremy mentioned, if there's questions along the way that we can answer, be happy to. But I think if nothing else, it's a worthwhile webinar, and it's a active conversation that's not going to end in this 30 minutes, but hopefully we'll spark some other questions and ideas, and there'll be more to it. So it goes without saying that we're in a regulatory and a market climate that is absolutely mandating change, and it's throughout the industry. The central target, I think, is lenders. They have great clarity, on some of the regulations, while others, are far less clear. And the effect on the title industry and settlement agents in particular is even less clear than that. Topics like privacy protection, consumer complaints, data encryption, background checks, oversight and responsibility for any subcontractors or third parties. These are the areas that are, creating great degrees of uncertainty. I don't know, I think it might have been one of the participants, either Jeremy or Richard, but somebody had brought up a quote recently in American Banker, and it was one of the executives at Bank America, who was speaking about them having to now apply the same controls that they applied to their vendors are now being applied to their vendors' vendors. And the quote was, things that you might have previously described as best practices have become absolutely non-negotiable now. So in effect, what I think is the most important takeaway from this session and others as everyone thinks about the changes that some of the regulatory environment might bring is, how can you position yourself where not only do you find yourself on not find yourself on the wrong side of compliance, but are there ways that you could actually use your adherence to compliance as potentially competitive advantages. Compliance costs money and time. In a market such as the one we're in, where revenues are certainly not at all-time highs. It's difficult sometimes to want to invest the time and money for things that are not necessarily directly related to business development. On the other hand, not complying could wind up being a lot more costly. So I think in this webinar, we're hoping to share some sort of practical advice, some of our experiences, the trends, those hallway conversations I referenced, and begin a conversation that certainly will go on through 2015 and beyond. I think ALTA has done a great job staying ahead of the changes, providing guidelines and education in the form of the 7 pillars. This webinar is not going to be a primer on the pillars. I'm sure everybody has been pillared to death, but it is a perspective on how they may influence your working relationship and your procedures as they relate to all your partners in the services transaction. As I mentioned earlier, I think RedVision and Westcor provide 2 very different perspectives and experience as we walk through this subject. As an insurer, Westcor can share what underwriters are looking for in their agents, what distinguishes an agent. Also, as an underwriter, Westcor can share what lenders are saying, their demands of the underwriter, and how those might filter down to some of the oversight or demands for the agent. RedVision, as I mentioned, on the other hand, is a provider to the agents. We furnish title and examination services, so we're a partner. But as a provider, we are being held to higher standards now. We recently, for one of our large national clients, had to not only give them assurances that we did background checks on all our own employees, and nationwide we do that as a normal course of practice, but any vendors we were using, to procure public record in any of the non-digital counties, et cetera, that we had to have the same assurances, for any third-party providers. So when you think about, how that runs downhill, if you are using providers like RedVision, there's certain things that one day you may be accountable for that you're not today. And I think most importantly, while we don't know how all the regulations will play out, we know it's a highly charged regulatory and political climate. And I think one of the big concerns is just that everything any kind of bad consumer experience, especially, is going to be magnified, and things like that can create overreactions. So I think the big takeaway is that bad consumer experiences will be magnified, and it's in all our interest. Everybody that has a place in the the title industry to operate within those best practices. So while we're not going to review each pillar, as I mentioned, we are going to use it as a framework to provide some of the perspectives. And with that, I'm going to ask Richard to kick it off with even starting with the basics around license.
Thanks, Brian. We can go ahead and briefly summarize the slide that Jeremy has up right now. That historically, lenders, and I'm going to address this in a large measure from the perspective of lenders, because as an underwriter, we are finding ourselves more and more responsive and responsible to the large lenders who are dealing with individual agents. They're concerned about the fact that they have no immediate oversight and control, and they're looking at the underwriter as the intermediary to help facilitate accomplishing the expectations that the CFPB has laid upon lenders. I do have this perspective not only from my history with Bank of America, but also with Westcor. We've had the occasion to either be engaged in active ongoing discussions or actually documenting master services agreements. The large lenders were all focusing on many of the points that Brian had raised in his introductory remarks. And so I can tell you that we can go to the next slide, Jeremy. The best practices that were laid out by ALTA last year have really got the attention of the lenders, because like everybody else, they're navigating in uncharted waters. They know that they're answerable to a regulator who can inflict mighty pain, both reputational pain and financial pain. And to them, having something tangible and concrete to look to and identify as the basis for their having developed reasonable and reliable processes to ensure that they have done the best they can to regulate the transaction, to have credible, reliable parties in the workflow chain that they can represent with certainty to their customers, are going to provide them with professional support, with scrupulous attention to the matters involving privacy, and that these customers can expect that they are dealing with people who have met the standards necessary to, or at least have demonstrated the credentials necessary to execute the function they execute. We can go to the licensing pillar 1 slide, Jeremy. This is not really news to anybody on this call. Critical to executing the function of a title agent, and from our preview, we understand that most of the people on the call today are agents, employees of agencies. Don't know, I think I saw one lender who was represented in the call, so I will certainly with the lenders as much as I can since you're so outnumbered. But the critical factor, of course, is that everybody doing this kind of work, if required by the state, has to have and maintain licenses. That used to be sort of a no-brainer, except for the handful of states, we're down to 1 now, that do not have any mandatory requirement that involves licensing title agents. Kentucky will probably get in line one of these days very soon. And depending on the rigor of the various states, licensing is going to involve either having been grandfathered in by virtue of having had a license and been actively involved in the business for several years, or as some of you know, if you apply now or if you're applying to a state from which you're a non-resident, there may actually be an examination that demonstrates that you've got the knowledge of good business practices. For those agents who are looking at branching into other states besides the state of their domicile, it is critically important to understand what other states expect. Your underwriter is going to look to know that you have met the necessary criteria as far as being licensed in a non-resident state. There's a website referred to in this slide that the NAIC, National Association of Insurance Commissioners, maintains that will point you to the relevant laws for any state that you want to investigate getting licensed in. Understanding that some states will require bricks and mortar, some states will require a physical presence in the state, and the variations are numerous. There aren't 50 variations, but there are several that you're going to need to know about. We have more on this on the next slide. You want to know whether or not you have to have a physical office. You want to know what kind of name considerations constrain the ability to do business. In the West, in particular, there's a requirement that you have title plant ownership. You can't just show up and say that I want to start doing business in the state. A condition preceding to getting licensed is providing evidence that you got access to a title plant. You're not going to go to the land records offices to do this kind of work. Controlled business is always a consideration. In some states, you may not get a license unless you can demonstrate that the business you're going to be executing is significantly obtained from the public at large. You're not going to be fulfilling the work of an affiliate, owner, or a company that you own. There are, of course, the requirements that once you get a license, you have to be appointed. And then once you've got your license and appointment, another matter that's more important today than ever is that you maintain the ability to keep track of when your license needs to be renewed, keep track of your continuing education if that's a requirement, because all of these things are only going to be more front and center in the eyes of the lenders with whom you work and the underwriters by whom you're appointed and the regulators who are all much more sensitized to consumer interests. That covers licensing. In a brief pause, we can go ahead to Pillar 2, which is escrow account controls. Once again, this is not a surprise to folks that have been in the business. The escrow account controls are only more and more critical. It only takes one or two lurid stories about escrow accounts having been raided by a dishonest or desperate title agent or title company to get the attention of lenders. And lenders, when great notoriety is involved in a company going bust with millions of dollars unaccounted for, lenders today realize that they don't have any way to make that money get restored. They've been given to understand that the closing protection letter is not tantamount to a blank check to recover the fund that an escrow agent or that a title agent has taken out of an escrow account. Lenders do not want to be hanging out there because to them it exposes them to both personal risk, reputational risk, and consumer feedback, which is just awful. So reconciling the accounts is essential, and demonstrating that you've got a professional ability to keep after this kind of work is also essential. Next slide here.
Yeah, this is Brian from RedVision. So, you know, here's an area where we've seen a great change over what I would describe as maybe the last 18 to 24 months. RedVision, in its capacity of furnishing title research and examination services, technically speaking, we're exposed only to public record. Having said that, you know, some public records, even though it's a very small percentage, could contain, you know, things that would be, you know, categorized as, you know, identity information. For example, you know, some of the older mortgages may have a social security number and so on. And as a result of that, you know, we've done a couple of things proactively, and then we've had to do some things very reactively to make sure that we could serve certain clients who are becoming more demanding, even though, again, you know, we are not in the forefront of privacy information. On the proactive side, even though 99.9% of the information we touch is public record, we put a whole layer of our management group from the operations side through privacy programs, in particular the one offered by Data Shield. And you know, that was to make sure that in the event any of us, you know, on the production side were exposed to any information, that we understood the sensitivity and that it had to be treated in a way different than we would public information. On the other hand, we've you know, represented to clients and to you know, prospective clients that when you are ordering title from us that we do not need, nor do we want. Information that, theoretically could help the search, for example, maybe the last 4 digits of the SSN, but that we'd rather not have them. We don't need them to, to perform our services. And, technically speaking, you as an agent should not be providing them to a third-party vendor. So, one little hint here would be if you do have, third-party search or abstract firms that are, preferring that or requesting that you send that, with information to perform title searches, I'd encourage you not to. They're not required. You can do, high-quality searches without it. And what you don't want to do is be in a position where somehow that got exposed, because again, in the future world, you can't hide behind, the fact that that was not your employee or your company. If it's a vendor you've chosen, one way or the other, you're going to be on the hook. Next slide. I think, Richard, yeah.
Yeah, I'm trying to think of the best way to make this sound like it's new information. I guess the best way to tell you is that in this day and age, that's the way we've always done it. It's not going to cut it as far as any discrepancies or concerns or questions that arise with respect to your underwriter and to a lender for whom you're doing work. It's essential that your settlement policies, your settlement procedures track with what is currently of greatest concern to the lender, and that means you've got to be very mindful of changes that go on locally in your state and also in other states. Once again, I don't mean to just beat the multi-state agent, but that when you get into different jurisdictions, that means that you are accountable for regulatory changes in every jurisdiction in which you're doing business. The best thing to do is to have an aggressive and heightened awareness of what would be appropriate policies and conduct ongoing employee training so that you know that you've got the current best practices in mind. Be mindful of litigation. Be mindful of regulatory changes that come in the state or even in other states, because anything, the NAIC, among other things, is a body that gets together on a quarterly basis, and those regulators talk to one another. And so what may wind up as a best practice in Wisconsin based on a regulator there has an incredible ability to cross state lines or maybe even leapfrog from time zone to time zone. And so it's very good for every agent to be aware. Keep your eye on the trade papers. Know what's going on and adjust your best practices accordingly. You can go to the next slide. I'm sorry, I think we skipped one there. Can you back up? No, we just consolidated. I apologize. I have one more point that I want to make on the previous slide, and that has to do with recording. Now more than ever, lenders, back up one, Jeremy, please. Now more than ever, lenders are keeping close track of the time lapse between when a loan closes and when they get both recording confirmation and when they get the title policy. Track the closing instructions. Pay attention to what the closing instructions say. Lenders will often put some fairly specific and measurable requirements into the lender's closing instructions. And when you as an agent undertake the responsibility to transact the business for the lender, to accept the loan proceeds, and to disperse and close the loan, you're committing yourself contractually to account to them if they're not happy with what's been done. That means that they want to know the documents have been timely recorded, that they're being tracked, that if issues arise, they are being addressed, and that the rates that are being charged the consumer, since the lender with the new good faith estimate or the combined disclosure is accountable to the consumer for variances, and regulators are increasingly aware of and concerned about any times that there's an agent that is charging a consumer more than what should be the best possible rate based on the consumer's qualification for a reissue rate, a refinance rate, any other kind of discount that's available. So it is essential to be aware of changes in your underwriters, practices. They certainly ought to be promulgated before they do. But because now there are at least 3 people who are going to be paying attention to the rates and fees that you charge, it's important that that they reflect what's not only usual and customary, but also fair and reasonable based on the published rates of the underwriter on whom you're writing the policy. Okay, now we can move ahead. 5.
Yeah. So obviously, this is an area that RedVision plays in quite a bit. But I think what we could bring to the sort of regulatory and compliance conversation here is in a lot of the states, the actual practices for what are best practices for, title searching, say, behind an REO versus a refi or whatever. Very often they're known, and clearly, agents in those markets are experts at those types of requirements, but it's not really a codified body of knowledge, or at least nothing that seemed to be universally accepted by all, say, underwriters in the market or as a regular practice. So in our case, we took it upon ourselves to document what we believe to be state by state these best practices. HOAs in Florida or municipal liens in New York and so on. And we took that body of work to the underwriters. And not necessarily that they were endorsing RedVision as a company, but that they were endorsing the standards of the searches that we were performing. Because our feeling was if we could establish some consensus around what these best practices were, and then to the extent you can, eliminate the amount of touch points or, opportunities to, to deviate from those practices, that at least the core, information that's obtained pre-closing would then float through as data into, our client's systems, so that the closing and post-closing process had, flawless opportunities for, error, be it translation of data or rekeying data or things like that, as well as having an auditable body of documents to stand on, where you can at least have a evidence that these are best practices, these are the requirements for our staff, and these are certified by our underwriters. So it's not a holistic answer for it all, but it's an example where in one component, just getting out ahead and saying if there is unclarity around standards, here's what I believe them to be, and getting them certified. I don't know if you'd add anything there, Richard. If not,
no, I think you've addressed that appropriately, and I do want to be mindful of the time so that we provide an opportunity for Q&A if there is any. Pillar 6 is insurance coverage, and getting back to that point that I had made earlier about keeping track of expiration dates, E&O coverage does have this nasty habit of lapsing or requiring renewal. Pay attention to that, because once again, lenders are more than ever very mindful of the need that they have some recourse and resource to look to in the event there's an error that is committed by the settlement service provider. Having errors and omissions coverage is a virtual requirement. Most agents' appointment agreements today are going to call for it. In addition to that, the more the better. I know that there's a cost-benefit crossover that, depending on the amount of activity an individual agent has, you're going to have to ratchet your coverage accordingly. There's no point in being overcovered, but there's nothing worse than being inadequately covered because of a lender uses that as a criterion for agent selection that may wind up being a differentiator that will work negatively to people with low limits. Having fidelity bond, a surety bond, or any other kind of supplemental program is certainly going to be of value added, because the lenders spend a lot of time in what-if mode, and underwriters have seen this from time to time. They want to know under certain scenarios if the insurance that's out there is going to cover them in the event of a loss. Underwriters as well. E&O coverage presupposes that there was an E error or an omission, and an E&O insurer can take the position that an intentional wrong, a tort committed by the agent, does not constitute either an error or an omission, hence the interest in fidelity coverage and surety bonds. If an agent has a trusted employee who violates that trust, and causes the agent some financial harm, having access to recourse through fidelity coverage or a surety bond is certainly going to give the agent peace of mind and also give the lender the confidence of knowing there may be a resort to go to, even if the loss of the funds is outside the scope of coverage by the underwriter's closing protection letter. Of course, for those of you in the audience who are in New York State, you know that New York doesn't permit closing protection letters. Vermont has some unusual constraints around the terminology in a closing protection letter. And that's why in New York in particular, lenders are very attentive to the existence and adequacy of E&O coverage because they regard that as the only resource they can go to. They know that the insured closing letter is not going to be accompanying the loan transaction anywhere within that state. Optical or something.
Yeah. So. In this sort of complaint section, the one point I think that I wanted to make here was, and this ties back to a highly charged sort of regulatory and political climate, where the one thing that will get blown out of proportion might be anything that is in that category of consumer complaint, and in this case, obviously we can all apply to the best we can, the best practices for the search and exams and closing and so on. But I think there is also a great importance about making sure your agency and your staff know how to respond when problems do arise, because they will, right, in all cases. And in some ways, those are also opportunities to stand out and shine, because I don't think anybody expects perfection. There are a lot of analogies in other industries, but if you've ever read In Search of Excellence, the book, there are some companies that, built their sort of customer culture around what they call moments of truth, which were the inevitable times that there is going to be a service problem. But if you respond phenomenally during those moments of truth, you actually stand out, because people generally don't remember the things that went well, but they very, very well remember the things that happened. So I think, although everybody, that is a title agent is accustomed to high degrees of service, et cetera, I think we have to be mindful that, with the consumer experience, when things do go awry, it is an opportunity to actually build a loyalty not only with the customer, but, deter a complaint that might have otherwise, triggered other types of problems. So I think, Jeremy, we're on our time here. I don't know running over, but certainly if there's any questions.
Yeah, sorry about that, Brian. I had my mic muted. As a reminder, if anyone has any questions, please submit them via the chat box. We did have one come in from Kim, Richard, and it's when you were talking about the E&O insurance, and just want to know if the $1 million is absolutely required. She said if she has a policy limit that's over, she gets over the limit approval from her underwriter.
$1 million as I had indicated, is going to have a lot of dependencies, much of which is going to be the number of transactions that the agent handles, the amount of money that's sitting in the agent's escrow account at any given time. I have actually talked to lenders who have considered, once again, going to New York. We want to see that the attorneys who handle closings for them have a lawyer's professional liability policy that equals or exceeds the total amount of loan proceeds that might be sitting in that attorney's escrow account at any given time. That hasn't been met with a warm reception, because particularly in Manhattan, if a lawyer handles 6 transactions in a month, there may be an overlap where they could have millions of dollars, millions and millions of dollars representing loan proceeds. So the $1 million is a rule of thumb, but it should bear some reasonable resemblance to the total activity or volume of work or dollar amount of funds that are being handled in the aggregate or at any one given time on a rolling weighted average basis. And once again, that's got to be offset against reasonableness if the $1 million coverage is way in excess of the amount that a given agent really believes is at risk in the escrow account at any point in the month, then go ahead and wind it down. But have a good explanation as why you have the coverage that you have, because simply because it's expensive, and I know E&O coverage is more expensive than it used to be, it still needs to be reasonably related to the amount of activity the agent conducts.
Okay, all right, thank you, Richard. Question that came in, and maybe each of you can offer a little perspective from your world, and the question is, what kind of documentation should a title company get from its vendors that show they follow best practices? Any advice on what a title company should be looking for from its vendors?
I mean, I can speak from RedVision, which obviously we're not providing a full array of services, but in the areas that we do, which would be the more traditional sort of search, abstract, title examination services, it's really come in two forms. There is a large national client that actually had a very large document, and you could tell it was probably drafted in their compliance office, and I'm sure was being driven by lenders to them. In other words, what they were being required to do, and it was a full questionnaire. We had to describe the process we put our employees through. Again, background checks, training, various labor, conditions, and then for the first time, and this was a first time for us, we also had to apply those same standards to any vendor we used. So, even if it was an abstractor, that we've used from time to time in Vermont, we had to go behind, the normal contract and representations that they would make, and actually incur the cost to do a basic background checks. So that's the more formal. In terms of just practices in general, that's where some would ask officially, some would ask more informally, but we felt it was worthwhile, and this is that example of maybe using the regulatory environment as a way to stand out, but we felt it was a worthwhile investment to document our best practices, even though we didn't universally have to, because now we could sit down and show a prospective client or a client exactly what diligence we're providing to a search in that state for that type of product, and also show the endorsements from underwriters for those search practices.
Hey, Rich, how about from your perspective? Any information you can share on what you're seeing from Westcor's agents and what they're doing?
Well, there's a whole range of things. For a while, there were a couple of companies that were offering some independent service deemed to be an objective analysis of an agent's business practice that would result in a certification of some description. Lenders were initially intrigued by that, but then they realized that the certification was really only as good as the net worth of the company standing behind that investigation. And so it continues to be somewhat of an amorphous moving target as to what lenders want to see and what underwriters would like to have the agents demonstrate. And every underwriter has got different input from the folks to whom they speak. I think that right now the best thing to do, to the extent that every agent has got to have some compliance responsible person, not necessarily a dedicated person, but somebody in the office is going to have to be thinking in terms of how to demonstrate or document that they are aware of and making their best efforts to deal with the best practices. As Brian suggested, having some written confirmation or written statement of your procedures is a great first step. And until something winds up being codified and we come up with an industry standard as far as what's an acceptable way to validate and verify, I'm pretty confident you're going to find that ongoing and annual audits by underwriters will be paying more attention to policies, practices, and procedures to see if they can't be utilized as a way to help surface and flush out areas where there might be really great practices in place, or areas where there are room for improvement.
All right. Yeah, thanks, Rich. And we're about 10-15 minutes past our deadline, so I think we're going to call off the dogs on questions. If you have anything to follow up with Brian or Richard, their contact information is on the screen. And tied to this and looking ahead to our next webinar in August, we will be addressing how to prepare for a best practice assessment. And we will have representatives from several firms that conduct assessments to walk through the process, explain the hurdles, and to share some case studies. So keep an eye out for information about that webinar. As a reminder, if you missed parts of today's webinar, if you think others in your office would benefit from listening, a recording of the presentation will be available for replay early next week at alta.org/title topics. Again, that is alta.org/title topics. And again, if you need a copy of the presentations, send me an email at jyowie@alta.org. And also, if you have any webinar topics that you think we should be considering for future presentations, please send me an email as well. And with that will bring us to the conclusion of today's presentation. Brian and Richard, thank you for joining us today.
Pleasure. Thank you.
All right, and I hope all the listeners found today's presentation useful. Take care, everyone.